Commercial real estate is imploding right now, and most people have no idea how bad it actually is. Right now, there are trillions of dollars in commercial real estate that's underwater. Office buildings in major cities are selling for pennies on the dollar. Banks are quietly writing off billions, and the ripple effects are about to hit everyone, whether you own property or not. In the next 10 minutes, you're going to learn 15 concepts that explain exactly what's happening, why it's happening, and what comes next. These aren't opinions. These are the mechanics of how real estate crashes actually work. And once you understand them, you'll see the headlines completely differently. This breakdown synthesizes data from the Federal Reserve, MSCI Real Assets, CoStar, and industry reports that institutional investors pay thousands to access. The patterns are clear if you know what to look for. Let's get into it. Number one, repricing. Everything starts with repricing. And this is the concept most people completely misunderstand. Here's what's happening. For over a decade, commercial real estate was priced based on one fundamental assumption. Interest rates would stay low forever. When money is cheap, buyers can pay more for buildings because their financing costs are minimal. A building that generates $1 million in rent might sell for $20 million, $25 million, even $30 million. But when interest rates spike, something brutal happens. That same building generating the same rent suddenly becomes worth far less. Not because anything changed about the property, not because the tenants left, not because the roof collapsed. The math simply stopped working. Think of it this way. If you could borrow money at 3%, you might pay 25 times the annual rent for a building. At 7% interest, you might only pay 15 times. Same building, 40% less value overnight. The Federal Reserve raised rates faster than any time in 40 years, and the entire commercial real estate market is now going through a painful repricing. Buildings that traded at certain values in 2021 and 2022 simply cannot fetch those prices today. The buyers who would pay those prices no longer exist because the math doesn't math anymore. This repricing isn't a negotiation. It's not about finding the right buyer. It's physics. When capital costs double, asset values get cut. Period. And here's the kicker. Most buildings haven't actually repriced yet. Owners are holding, pretending the old values still apply. But the market knows. And eventually, reality catches up. Number two, speculation. Now let's talk about how we got here, and that means talking about speculation. During the low-rate years, something wild happened in commercial real estate. Buyers stopped purchasing buildings based on what they actually earned. Instead, they bought based on what they hoped buildings might earn someday. This is speculation, paying for a future that hasn't happened yet. Here's how it worked. A buyer looks at an apartment complex that's currently collecting $8,000 per unit in annual rent. Instead of valuing the property on that actual income, they project that rents will grow to $12,000 within 3 years. They underwrite the deal at the future number. They pay as if the growth already happened. When rates were low and rents were climbing, this actually worked. Buyers would speculate, rents would rise, and they'd look like geniuses. The strategy became standard practice. Everyone did it. But speculation requires two things: cheap money to fund the gamble and rising rents to validate it. When both disappeared, speculators got trapped. They paid 2024 prices in 2021. Now it's actually 2024, and those projected rents never materialized. The buildings never grew into their price tags. The most dangerous speculators use short-term debt to fund long-term bets. They assumed they could refinance in 3 years at similar rates. That assumption blew up spectacularly. Now they're underwater, over-leveraged, and out of options. Speculation turned commercial real estate into a casino, and the house is now collecting. Number three, proformas. Speculation lives inside something called the proforma. And if you want to understand this crash, you need to understand proformas. A proforma is a financial projection. It's a spreadsheet showing what a property's income and expenses will supposedly look like over the next 5, 7, or 10 years. Every commercial real estate deal involves a proforma. Banks require them. Investors study them. They drive every pricing decision. The problem? Proformas are fiction dressed up as math. Whoever creates the proforma controls the assumptions, and during the boom, assumptions got increasingly aggressive. Rent growth, 8% annually. Vacancy, down to 3%. Expenses, flat. Cap rate at exit, 4%. Plug in optimistic assumptions and any deal looks amazing. The proforma says this property will be worth double in 5 years. It's right there in the spreadsheet. Numbers don't lie, right? But here's the truth. Proformas are as reliable as the assumptions behind them. Garbage in, garbage out. And for years, garbage assumptions drove record-breaking purchase prices. Now, reality is auditing those proformas. The rent growth didn't happen. Vacancy jumped. Expenses spiked with inflation, and the exit cap rate, nowhere close to 4%. Sophisticated investors know to stress test proformas. What happens if rates rise 2%? What if vacancy doubles? But during the boom, nobody wanted to run those scenarios. The deals only worked with rosy assumptions. Every building that's underwater right now has a proforma somewhere showing it should be fine. The proforma lied. Number 4, rent drops. Here's where things get real. Let's talk about rent drops. Commercial real estate values depend entirely on income. Unlike your house, which might hold value based on location and comparable sales, commercial buildings are valued almost purely on the rent they collect. Higher rent means higher value. Lower rent means lower value. And rents are dropping fast. In the office sector, effective rents, meaning what tenants actually pay after concessions, have fallen 20 to 40% in many markets. That's not a typo. Landlords are offering free rent, improvement allowances, early termination rights, anything to fill space. Multifamily had its own rent boom during the pandemic. Everyone thought those rents would keep climbing. Instead, new construction flooded the market and rents plateaued or dropped in dozens of metros. Sunbelt markets that were on fire are now seeing concessions everywhere. Here's the math that matters. If a building's rent income drops 20%, its value typically drops more than 20%. That's because cap rates, which we'll cover soon, amplify the effect. Lower income at higher cap rates equals dramatically lower values. Some investors thought they could ride out a rate spike if rents kept growing. But when rents drop at the same time rates rise, there's nowhere to hide. The income side and the valuation side both turn against you simultaneously. Rent drops are the crash showing up in the operating statements. And those operating statements are getting ugly. Number 5, cash burn. When rents drop and rates rise, buildings start burning cash. And cash burn kills. Here's the scenario. An investor bought an office building in 2021 with floating rate debt at 4%. The building generated just enough income to cover the mortgage, pay expenses, and leave a small profit. Everything balanced. Then rates went to 7%. That mortgage payment just jumped 50% or more. Meanwhile, 2 major tenants didn't renew. Suddenly, the building isn't generating enough income to cover its costs. Every month, the owner has to write a check. That's cash burn. In residential real estate, if your mortgage costs more than your rental income, you can often float it. Maybe a few $100s a month. Annoying, but manageable. In commercial, the numbers are different. Cash burn might be $500,000 a month, $1 million more. Owners have to fund that shortfall from other sources: personal wealth, other properties, investor capital calls. Most owners don't have unlimited cash. They can burn for 6 months, maybe 12, maybe 18 if they're well capitalized, but eventually the cash runs out. And here's what makes it worse. While you're burning cash, the property is also losing value. So you're paying to own an asset that's becoming worth less every month. That's a devastating psychological trap. Cash burn is the clock ticking toward default. Every month, the owner has to decide, fund the shortfall or hand the keys back to the bank. Right now, thousands of buildings are facing that exact decision. Number 6, fire sales. When cash burn runs out, fire sales begin. A fire sale happens when an owner must sell immediately, regardless of price. They can't wait for better conditions. They can't negotiate for higher offers. They need to get out now. The causes vary. Sometimes it's debt maturity. The loan is due, they can't refinance, they must sell. Sometimes it's capital calls. Investors refuse to put in more money. The fund unwinds. Sometimes it's simply running out of cash to cover operating losses. Fire sales set market prices. And right now, the fire sale prices are ugly. A 60-story office tower in Los Angeles that sold for over $200 million a few years ago just traded for under $50 million. That's not a discount. That's a 75% loss. A downtown St. Louis office building that sold for over $200 million traded for $3 million. Not a typo. $3 million. Now, these are extreme examples, often involving special circumstances like heavy debt or functional obsolescence, but they establish comparable sales that appraisers must reference. When someone asks what buildings are worth, these fire sales provide data points. Fire sales create a spiral. One desperate owner sells at a low price. That sale becomes the new comp. Other buildings get reappraised lower. Those lower appraisals trigger covenant violations or margin calls. More owners become desperate, more fire sales. The market hasn't seen the worst of it yet. Fire sales accelerate when debt matures and owners can't refinance, and a massive wave of maturities is coming. Number 7, haircuts. Let's talk about haircuts. And not the kind you get at the barbershop. In finance, a haircut is when a lender agrees to accept less than the full amount owed. The borrower owes $100 million. The lender takes $70 million and writes off the rest. That $30 million loss, that's the haircut. Haircuts are becoming common because the alternative is worse. Here's the situation. A building was bought for $100 million with $70 million in debt. Now the building is worth $50 million. The borrower can't pay, can't refinance, and can't sell for enough to cover the loan. The lender has options. They could foreclose and take the building, but then they own a property they don't want, in a market they don't understand. With management headaches they're not equipped to handle. Banks aren't building operators, or they can take a haircut. Accept $50 million, write off $20 million, and move on. The loss gets recognized, but at least it's done. No more uncertainty. Right now, billions in haircuts are being negotiated behind closed doors. Borrowers and lenders are playing chicken. Each side knows the building is underwater. The question is, who eats how much of the loss? For banks, haircuts create real problems. They have to recognize the loss on their books. That hits their capital ratios. Too many haircuts and the bank itself gets in trouble. This is why banks often prefer to extend loans and pretend everything is fine. Taking the haircut means admitting the loss. And nobody wants to admit how bad the losses really are. Number 8, cap rates. You keep hearing cap rates mentioned. Let's break this down because cap rates are the heartbeat of commercial real estate valuation. Cap rate stands for capitalization rate. It's calculated by dividing a property's net operating income by its price. If a building generates $1 million in annual income and sells for $20 million, that's a 5% cap rate. Here's the critical insight. Cap rates move inversely to prices. When cap rates go up, prices go down. When cap rates compress, prices rise. During the low-rate era, cap rates hit historic lows. Industrial properties traded at 3% cap rates, multifamily at 4%, office at 5%. Those low cap rates meant sky-high prices, but cap rates are linked to interest rates. When you can earn 5% in a treasury bond with zero risk, why would you accept 5% from a commercial building with significant risk? You wouldn't. You'd demand a higher return, which means you'd pay less for the property. Cap rate expansion is now ripping through the market. Industrial cap rates moving from 3 to 5%, multifamily from 4 to 6%, office from 5 to 8% or higher. Here's the devastating math. A building generating $1 million annually at a 4% cap rate is worth $25 million. At a 6% cap rate, it's worth $16.7 million. Same income, 33% value destruction. Cap rate expansion alone, without any change in rents or operations, has wiped out trillions in property values, and rates may stay elevated for years. Number 9, oversupply. While demand was falling, supply kept coming. That's oversupply, and it's crushing multiple markets right now. During the boom years, developers broke ground on everything: apartment buildings, industrial warehouses, office towers. Construction loans were cheap, land was available. Everyone wanted to capture the growth. Development takes years. A building started in 2021 delivers in 2024 or 2025. By the time it's finished, market conditions might be completely different. And market conditions are completely different. The Sun Belt apartment markets are the clearest example. Austin, Phoenix, Nashville, Raleigh, Charlotte all experienced massive multifamily construction booms. Developers looked at pandemic-era migration and rent growth and bet everything on continued growth. Now, those units are delivering into a market where demand has slowed and rents have flattened. Occupancy is falling. Landlords are competing for tenants. Concessions are everywhere. Industrial had a similar story. E-commerce was exploding. Everyone needed warehouses. Developers responded with a construction frenzy. Now vacancy rates are climbing and rent growth has stalled. Oversupply takes years to absorb. Even if no new buildings start today, the supply already under construction keeps delivering. The pipeline doesn't stop overnight. This creates a painful dynamic. Buildings completed during the boom must compete with desperate existing owners slashing rents. Everyone races to the bottom. The oversupply hangover can last 3 to 5 years. Markets that looked unstoppable 18 months ago now face years of pain. Number 10, floaters. Now we're getting into the debt mechanics, and floaters are where the most damage is happening. A floating rate loan has an interest rate that adjusts with market rates. When the Fed raises rates, your mortgage payment rises. When rates fall, your payment drops. Floaters are the opposite of fixed-rate loans, where your rate stays constant regardless of market conditions. During the low-rate era, floaters were incredibly popular. The logic seemed sound. Rates were low and seemed stable. Why pay extra for a fixed rate when floaters were cheaper? Plus, floaters had flexibility, making them easy to refinance or exit. Then the Fed raised rates 400 basis points in 18 months. Every floater repriced upward, dramatically. A $200 million loan at 3% costs $6 million annually. At 7%, $14 million. That's $8 million in additional annual debt service that the borrower never underwrote. Buildings that were profitable at low rates became cash-burning money pits at high rates. The income didn't change. The expenses didn't change. Only the interest rate changed. And that change was enough to make deals non-viable. Many floater borrowers bought interest rate caps, which are insurance policies limiting how high their rate could go. But caps expire, and when they expire, the full rate impact hits. The floater crisis is rolling through the market right now. Every month, more caps expire. More borrowers face the true cost of their debt. More deals blow up. This is mechanical destruction. No bad luck, no mismanagement, just debt structures that couldn't survive a rate shock. Number 11, maturities. Beyond floaters, there's an even bigger time bomb. Maturities. A maturity is when a loan comes due. Commercial real estate loans aren't like 30-year home mortgages that you pay down over time. They're typically 5 to 10-year terms with a balloon payment at the end. When the term is up, you have to pay off the entire remaining balance or refinance. And refinancing in this market? Often impossible. During the boom, buildings were financed at low rates and high valuations. Now rates are higher and values are lower. The math for refinancing doesn't work. Here's a typical scenario. An owner bought a building for $100 million in 2020 with a $65 million loan. Today, that loan matures, but the building is now worth only $50 million. No lender will refinance a loan that exceeds the property value. The borrower has to come up with the difference, called a paydown, or they default. Most borrowers don't have $15 million sitting around. The maturity wall hitting from 2024 through 2027 involves over $2 trillion in commercial real estate debt coming due. Not all of it is underwater, not all of it will default, but a significant percentage faces this exact math problem. This is why you're seeing extend and pretend, lenders rolling loans forward, kicking the can, hoping conditions improve. But extend and pretend only works if values eventually recover. If they don't, it just delays the inevitable. The maturity wall is a slow-motion train wreck. The timing is known. The math is known. The outcomes are predictable. Number 12, debt funds. Banks aren't the only lenders facing problems. Let's talk about debt funds. Debt funds are private investment vehicles that make commercial real estate loans. During the boom, they became massive. Pension funds, insurance companies, and wealthy investors poured money in, attracted by yields higher than traditional fixed income. Debt funds often took risks that traditional banks wouldn't. They lent at higher loan-to-value ratios. They funded transitional properties, meaning buildings in the middle of renovations or lease-ups. They did floating-rate loans to value-add plays. The pitch made sense in a low-rate environment. Earn 7% while treasuries pay 1%. Yes, there's risk, but real estate is safe, right? Now, those debt fund portfolios are a disaster. The underlying loans are defaulting. The collateral, meaning the buildings, is worth less than what's owed. The funds can't make distributions to their investors. Some debt funds are marking down their portfolios. Others are refusing to show current valuations. A few are quietly restructuring, trying to avoid triggering investor redemptions. The opacity is deliberate. Debt funds aren't publicly traded. They don't have to disclose losses in real time. Investors often don't know how bad things are until the fund itself announces a problem. When a debt fund fails, it creates ripples. Investors, often pensions and endowments, take losses. Future lending capacity decreases as capital exits the space, and borrowers who relied on debt fund financing lose access to capital. Debt funds were the shadow banking system for commercial real estate. That system is now cracking. Number 13, liquidity. All these problems compound when liquidity disappears. And liquidity has vanished. Liquidity means the ability to buy or sell an asset quickly at a reasonable price. In liquid markets, if you need to sell, buyers are available. In illiquid markets, you might not find a buyer at any price. Commercial real estate has become deeply illiquid. Transaction volume has collapsed 70% or more from peak levels. Buildings that would have had multiple bidders in 2021 now sit on the market with no offers. Buyers are waiting. Lenders are cautious. Capital is frozen. Why does liquidity matter? Because without it, price discovery fails. If nobody's buying or selling, there's no market price. Owners claim their buildings are worth last year's values. Lenders pretend their loans are money good. Everyone lives in a fantasy of stale appraisals. But illiquidity doesn't make problems go away. It just hides them. The moment someone must sell, typically due to a maturity or cash burn, they discover the actual market price, and it's usually much lower than the fantasy price. Illiquidity also traps investors. You want to exit a real estate fund? Good luck. Redemption queues are months or years long. Your capital is locked in assets that can't be sold. The lack of liquidity is why this crash has been slow motion. Fewer forced sales mean fewer price discoveries. But every forced sale that does happen reveals ugly truth. And those truths accumulate. When liquidity eventually returns, and it will, the adjustment will be violent. Number 14, office lag. Let's talk specifically about office, which has its own special problem. Office lag. Office leases are long. Typically 5 to 10 years, sometimes longer. That's very different from apartments where leases turn over annually. When a company signs a 10-year office lease, they're committed. Those long leases created a lag effect. Even after the pandemic made remote work permanent, for many companies, office buildings still looked healthy. Why? Because tenants were locked into leases signed years before. The rent kept flowing even as the desks sat empty. Now those leases are expiring, and companies aren't renewing. The data shows it clearly. Office utilization, meaning butts in seats, runs 40 to 60% below pre-pandemic levels in most markets. Meanwhile, lease expiration is accelerating. Companies that renewed during the pandemic on short terms are now making permanent decisions. And the permanent decision is often, we need half the space, or none. This creates a slow-motion disaster for office landlords. Every year, more leases roll. Every year, more tenants downsize or leave. The income statement gets worse progressively, not all at once. The office sector hasn't fully repriced because the worst hasn't happened yet. Buildings with 5 years of lease term remaining look stable today, but 5 years from now? The math looks catastrophic. This is why office is trading at such massive discounts. Buyers are pricing in the future vacancy that's mathematically guaranteed by the lease expiration schedule. Current owners are holding, hoping for a return to the office that isn't coming. Office lag means the worst is still ahead. Number 15, silent losses. Finally, let's talk about what you're not seeing. Silent losses. The commercial real estate market is built on opacity, private ownership, private loans, private valuations. Nobody has to disclose anything until they choose to. This means losses are hidden everywhere. A pension fund owns an office building that's lost 40% of its value, but they haven't sold it, so they haven't recognized the loss. They might carry it at cost, or use a stale appraisal, or employ some creative accounting. The loss is real, but it's silent. A bank has a loan backed by a building worth less than the debt, but they're extending and pretending, rolling the loan forward, not recognizing the impairment. The loss exists, but it's not on any income statement. Silent. A real estate fund shows flat performance while the underlying assets have cratered. How? They control the appraisal process. They choose optimistic assumptions. Investors see what the fund wants them to see. Silent losses. This silence is deliberate. Recognizing losses triggers consequences. Banks face capital requirements. Funds face redemptions. Owners face margin calls. Everyone has incentive to pretend everything is fine. But the losses are there. They're embedded in balance sheets across the financial system. Banks, pension funds, insurance companies, endowments, hundreds of billions in commercial real estate exposure, much of it underwater. The question isn't whether these losses exist. They do. The question is when they become visible. When extend and pretend fails, when maturities can't be pushed further, when someone somewhere finally marks to market, when that happens, the silent losses become very loud. So let's come back to where we started. Commercial real estate is imploding, not because of bad luck, not because of some unforeseeable event, because of repricing, speculation, aggressive performance, rent drops, and cash burn, because of fire sales, haircuts, cap rate expansion, and oversupply, because floaters repriced, maturities are hitting, debt funds are cracking, liquidity disappeared, office is lagging into disaster, and losses are being hidden everywhere. These 15 concepts aren't random buzzwords. They're the mechanical anatomy of a crash. Once you understand them, you can read any headline about commercial real estate and actually know what's happening. The next few years will be painful. But understanding the mechanics gives you an edge. Whether you're an investor, a worker in a building that might get sold, or just someone with a pension that holds real estate, knowledge is protection. If this breakdown helped you understand what's really happening in real estate, subscribe and turn on notifications. More deep dives on wealth, markets, and what nobody else is explaining are coming. Drop a comment with the concept that surprised you most. I read every single one.